Hey everyone, today we're going to be talking about credit spreads. This video is going to be broken into 3 separate parts, with the first part being me explaining and understanding this option strategy. This will allow for you to customize this strategy depending on the lifestyle and how you want to trade. So what that means is you can do trades where you have to manage them every week, every few weeks, every month, even a year. It all depends on what strategy you want, and that's what we're going to explore. The second part of this video, I am going to show you some of my top picks, recommendations for credit spreads, as well as ones that I've used in the past, and I'm going to show you some of those trades. And make sure you stick around for the third and final part, as I'm going to be showing off some tips and tricks for credit spreads, because as you test them out and learn with them, you'll learn that it's a little bit tricky to use. Before we get into the video, I want to explain who this option strategy is for. And the simple answer is it's for everyone. You don't need thousands and thousands of dollars to back up your trades. As you'll see through this video, some of them you only need $50 and even $10 to make great returns with your income strategy. My channel aims to educate the youth on options trading strategies for income that don't need an absurd amount of money. I'm just a college student. I don't have a lot of money. But when I work, if I have a little extra amount of money, I want to invest it somewhere. I don't just want it to have it sit in the bank and depreciate in value. And the great thing about starting on with options in the stock market is there's always going to be more time to build up more money, so you can play around with it, you can make mistakes, you can lose money, and that's totally okay because that's all part of the plan. Every loss you take, you gain experience and you gain knowledge. So you may find a strategy that works out for you. You may find one where maybe you weren't managing it correctly and you could be making a lot more money. All you got to do is take time, gain that experience, take those losses, and learn from them and grow. That being said, let's get into the video. All right, well, to start, what is a credit spread? What does that mean? Well, the whole concept of a credit spread is you're buying an option and selling an option. So with a call credit spread, you're buying a call and you're selling a call, and a put credit spread is you're buying a put and selling a put. A call credit spread is saying that I don't think this stock is going to exceed this number. So as long as it stays below this number, I'm going to make money. I'm going to earn that premium. A put credit spread is the opposite. It's saying I think this stock is going to stay above this number, and for every day that it does, I will earn part of that premium. To help you get a better visual, let's take a look at the SPY. So when you're starting off, whether you can do this on your phone or just on your normal desktop, you're going to need to have level 3 options open, which to do that, all you have to do is go into your settings, go to your account type, and change a few things in there. To start off, you're just going to go into your SPY options. Now with credit spreads, they say that the best expiration date is usually around 40 days out. So that one's close enough. And whenever you are starting a credit spread, you're always going to want to sell your option first. So let's just do a call credit spread for right now. So let's take a look at SPY. And let's see the past week, past 3 weeks. Okay, so it's still on an uptrend, but past week it's been on a little bit of a downtrend. So let's just say hypothetically you think that SPY is going to continue in this little downtrend and not make a recovery, which I think it already broke through, so I don't think it's going to stay in the downtrend. But for example, let's just say it is. So go at your 40 days, you're going to sell a call, and the cool thing about Robinhood is when you are selling options, there's this chance of profit. And pretty much what that goes off of is this delta right here. It's not always 100% accurate, but what the delta means is it's the chance of your option to make money. So if you times this by 100, you get 40. So that means there is a roughly 60% chance that you will make money with this option. If you want to be more safe, you're going to want to go for a lower delta. So right there, that's around, you get 30% chance you'll lose money, or 70% chance you'll gain money, whatever works best for you. Usually, it's better to stay on the safe side. You will make a little bit less premium, but chances are it's going to go in your favor, and It's better to have a little bit of amount of money than to be a little bit more aggressive and lose that money. It's a good thing to remember is you're never going to lose money if you take profit. If you cash out, it's totally okay. So let's try for this one. This one right here has a 30 delta. So this one, it's very safe. Robinhood says a 76% chance to earn income. As you can see right here, nice, beautiful graph. As you can see right here, this max profit is pretty high, but there's a max loss of unlimited, and that's because whenever you sell options, you need 100 shares or the funds for 100 shares. So this one, it's not right. It's not set up correctly. So what you have to do is now you cover your call. So you buy a call right above the mark. So boom, look at that right there. Max loss went down to $67 and your max profit is 32. So as long as the share price for SPY stays below this number right here, the 569, then you will gain that $34, $33. And that right there is a 50% return. So that is an absurd amount. You know, if you just do normal SPY, let's check it out for the day. Normal SPY for the day, let's do the month. Let's do the month. For the month, okay, 1.5%. That's still a great return. But if you have this for a month, that's 50% return. It's all about the risk you're willing to take. And the nice thing about Robinhood is, let's say you agree with this, everything's looking nice, you could just add more to the contracts. So, you know, if you're willing to risk more capital and you have the capital to spend and you want a higher profit, maybe you'll, instead of doing one contract, you'll do 10 contracts. So now your max loss is $670, but your max profit is $330, which is incredible. But it is important to note, you're not going to immediately gain that $130 or $340. That is something that comes over time. When you're buying options and selling options, it is very important to check out your theta decay. So right here, as you can see, the theta decay is negative 46. So that means each day that this contract goes on, you're losing $46 throughout your contract. Whenever you sell an option, you actually are in favor of the theta decay. So as you can see, the negative sign disappeared. So now each day that this contract is open, you're going to gain $46. And the thing about the credit spread is it combines these two. So going back over to our SPY options, let's say, so this is a bearish move right here. I think the market is going to go down. And so what I could do is I could just straight up buy a put. I think the market's going to go down. I want to buy a put expiring. Well, let's do the month one because that's how long the credit spread contract was. So this is for one contract right here, the premium, and we have to times it by 100. So that's going to be almost $800 worth of premium. And some people don't have that, and that's totally understandable because that is a lot of money for a contract. But with credit spreads, it allows us to have more leverage. So it's a lot more safe, and you're going to be making a lot more consistent returns. So check it out. Boom, only worth $50. So that's the basics of the call credit spread. Call credit spread, you're saying the stock is going to stay below the mark, and each day that it stays below, you're going to earn part of that premium through the theta decay. Next, we're going to talk about a put credit spread, which is the inverse. I think the stock is going to stay above this number. Going back to SPY, if you see it had a nice little dip right there. So let's say around the 550 mark. That's where SPY is going to stay above, if you believe that. So let's go to trade options. Gonna go out to that 40-day, and then start off with selling your option. So sell a put, we said the 550, which Robinhood says 70% chance. Look at the delta. The delta is still pretty high. So this one is going to be a lot more of an aggressive play. So first things first, we have to sell our option, and then right below it, we have to buy our option. Boom, right there. So this one's still almost about a 50% return, a little less, But still, that's great numbers. If you don't have a lot of capital to work with, this is a great strategy for you to slowly increase your money over time. One important thing to keep in mind is it's all about your percent growth. My personal goal is to hit 1% each week, and at the end of the year, that'll over 50% my total portfolio. So it's better to chase the more consistent, smaller growth than to do more risky strategies to get inconsistent, high premium. So that about sums up the whole gist of credit spreads. Believe it or not, it's pretty simple and it's that easy. Next, we're going to be moving on to my recommendations. SPY has been great for credit spreads. So that is definitely going to be my first recommendation. And as you can see right here, you can get a 50% play for only risking less than $100, which is crazy. One thing to note is that the more volatile or the more movement a stock has, the higher premiums that it will provide. And so some people really chase those higher premiums. So if we look at today for SPY, the market is still open, but it's only moved $5, which that's still a pretty good amount. But switching over to Tesla, it's moved over $10. So if you were to place a call on both of these at market open, you're going to be making a lot more money with Tesla. And so some people, they like more risky strategies. Hey, I really think Tesla's undervalued right now. I think it's going to increase in price. I want to do a credit spread. I want to do a put credit spread. So let's just look out and see how the options are. Now, one thing to mention when you are doing more risky strategies with credit spreads, you might need to change your expiration. I'm not really familiar with these strategies, so I'm still going to stick around the 30 to 40 day mark. I'm just going to go a little sooner than that to help get some of those costs down. So we're going to start off by selling our puts. Let's try to go a little bit more safe. So that's right there. It's good 30 delta. Let's stick around there. So again, just to be clear, if I want to buy a call on Tesla, let's see, around that mark. So this one right here, it has the delta 70. So that means that there's a 70% chance that this contract will expire in the money, which means it's just below the strike price. But it's going to cost $3,000 in order to do this call, which that is a crazy amount of money. That's almost my whole portfolio. So what we're going to do, we're going to sell that put. We'll do it at the 35 mark. And then we're going to buy the put right below it. And boom. So as you can see, you're risking a lot more, but you're going to be gaining still a crazy amount. And almost 50% return is great. Again, it is great. However, it is a lot more risky because Tesla's a lot more volatile. There's a higher chance that Tesla will move 5% in a day when SPY's only moved 1 or 2% per the day. This one right here is ticker symbol EWJ, which is a Japanese ETF of Japanese stocks. And it's really funny because the reason I actually did my first credit spread on this stock was because I was playing Fortnite with the random squads, and there was a guy talking to me, and he was an investment banker. He worked for a university. He helped manage their portfolio, which they taught their students, and I thought it was awesome. But as I was talking to the guy, I asked him for advice. I said, all right, so what's hot in the market right now? What should I look out for? And he says the Japanese market was increasing. Now, this was many, many months ago. But as you can see from a year timeline, he wasn't wrong. And let's see. Yeah, March 6th, that's when I performed my credit spread, which I think I only made like maybe $16 for it. But still, I thought that was kind of funny. You know, I meet this random dude online. He told me to invest in this. So I did a little research. I found the right one. And hey, it made me some money. So that's a good thing. It's always good to diversify the market. You know, the U.S. market is very strong, one of the strongest out there. However, when the U.S. goes down, some other countries, some other nations might have a strong, stable market. So it's important to, of course, do your research on whichever one you're going to go for. But always diverse. It's always good to diverse. You don't want to put all your eggs in one basket, as they say. The third and final section of this video are just some helpful things to think about when you are using credit spreads. And the first thing is time is your friend. So the whole concept of a credit spread is each day that passes where you're in the money, so the stock price is in the money, you will earn part of that premium through the theta decay that I showed you previously. So it's okay if the strategy is taking a little bit longer, or you may be in the red for a few days. That's totally normal. That's a part of the process. If your trade does happen to go the other direction, it's important that you actively manage it, and this can be done by either closing it or rolling the option, which I'm not sure how other brokerages are, but Robinhood is very easy. There's just another tab that you click right below buy or sell. And what this does allows for you to change the actual strike prices that you choose. And you can also change the expiration. So if your contract expires in a week and you're still in the red and you don't want to lose your premium, what you can do is maybe change some of the strike options, maybe go a little bit lower, be a little safer, and then you can also increase that expiration. You can also use this to further increase your profits if you are making money. So let's say your contract's doing well, it's about to expire, and you've earned maybe 80% of that max profit. All you do is roll the contract. You can, again, choose the same strike prices or change them, and then increase the expiration date to earn a higher premium. Another thing to think about with credit spreads is to not let it go to expiration. There are some strategies when you're strictly selling a naked put or selling a call. It's important to wait till expiration because you're still going to gain all of that premium. However, with credit spreads and with normal buying options, you do not want to wait till expiration, or you're going to end up losing all of your money due to theta decay. Another really cool thing about credit spreads is the ability to customize your strategy. So first thing you want to do is just start up with a normal credit spread. Go out your 40 days and start by selling the call on the amount you think it's going to stay below. So let's just go with that $61 mark. And a normal credit spread, you would just buy a call directly above. So look at that right there. Max loss is 50, max profit is 51. That's still a great return right there. But the cool thing you can do is maybe if this isn't enough money for you, if you want to try to increase that value, you can move that bought call to a different strike price. So now we do that one. Okay, wow. Now it's almost doubled in value. When doing this, one important thing to note is that the break-even price changes. So normal credit spread, we're at 561.52. Let's go one up. No, we're at 562. So the price of break-even is going to decrease, but you are going to gain a lot more for that max profit. Last thing to think about is that credit spreads are a multi-leg strategy. So when you are closing them, you're not just closing one leg individually and then the other leg individually. You're closing both of them at the same time, which can be kind of tricky. I've been in a few instances myself where I will close a credit spread and I'll accidentally keep one of the options going, and then I'll be down like a few $100s. I'm like, whoa, what's going on? But it's because I incorrectly closed it. And a lot of these things come with time. You know, you can watch as many YouTube videos as you want. You can test out as many things as you want. But you're not going to actually be able to know how to deal with it until you're in there doing it yourself. You're doing your own options, doing your own expirations, things like that. So some of it just takes a little bit of time to get used to the strategy and learn when you're going to be making the money and when you just have to sit it out. If you learned something new with this video, make sure to give it a like. And if you enjoyed this style of content, write it down in the comment down below. If you want to see anything new, any different type of videos, also leave it down there. Lastly, thank you all for listening, and I'll catch you in the next one.